החברה שלי, Sage Equity, זו חברה שמייצגת, שמשקיעה בנדל"ן בחו"ל, בעיקר בצפון אמריקה, והמבנה שבו אנחנו עובדים הוא מבנה של שותפויות עם גורמים מקומיים משמעותיים שמשתתפים בהשקעה בכל עסקה ומנהלים עסקה. היום בחרנו להביא לכאן את השותף שלנו מאטלנטה, חברה שנקראת Cortland Partners, ומי שידבר זה נשיא החברה, מרווין בנקס. החברה מתמחה בתחום של מגורים להשכרה, גם בונים שכונות מגורים שלמות להשכרה, וגם קונים שכונות מגורים שלמות, בעיקר מבנקים, נכסים שהם נכסים distressed, נכסים שבסיטואציות של פשיטת רגל, שהמוכר איבד את נכס לטובת בנק וכו'. שם נמצאות מרבית ההזדמנויות. מרווין ידבר על זה יותר בפירוט. אני רוצה להגיד רק שתי מילים על הנושא של מגורים להשכרה באופן כללי, כי זה סוג תחום שלא קיים בישראל ולא כולם מכירים אותו. בצפון אמריקה בערך 35% מהאוכלוסייה גרים בשכירות. הם גרים בשכירות בצורה בדרך כלל שונה לגמרי ממה שאנחנו רגילים בארץ. בארץ אנחנו רגילים שמישהו רוצה לגור בשכירות, אז הוא הולך ושוכר דירה בבית משותף ממישהו שקנה את הדירה להשקעה. ברוב השוק להשכרה בארצות הברית וגם בקנדה זה שוק של שכונות שלמות שנבנו מלכתחילה כשכונות להשכרה, ואז כשאנחנו מדברים על עסקה, אנחנו מדברים על לקנות שכונה שלמה שיש בה 150, 200, 300 דירות. חברה קונה את הנכס, ואנחנו לא מדברים על השקעה בדירה בודדת, אנחנו מדברים על השקעה בפרויקט, בשכונה שלמה שמנוהלת על ידי השותף שלנו, שגם משקיע בעסקה. זה מה שרציתי לומר ככה בשתי מילים, בשביל שיהיה ברור שכשאנחנו מדברים על מגורים להשכרה, אנחנו לא מדברים על לקנות בית אחד או שניים או שתי דירות, אלא על קומפלקס שלם. זה הרבה יותר יעיל, וזה שוק, כמו שאמרתי, שלא קיים בישראל. אני עובר לאנגלית. I'm going to invite Marvin Banks, the president of Cortland Partners, to give us his thoughts about the market, the apartment market, the multifamily market in the US, and specifically address several opportunities that we have at the moment. Sage Equity, my company, is representing Cortland in Israel, and we could discuss specific opportunities later. Marvin, please.
Thank you, Rizzi. And Itay, thank you for inviting me here tonight and for you for showing up. I must admit, this is the first time I've given a presentation to an audience who I don't speak your language. So I hope you can understand how my presentation tonight, and hopefully it'll make some sense and generate some interest that you can take advantage of to generate some wealth creation for yourselves and your clients. I believe Uzi talked a little bit about what Cortland Partners does, investing in apartment properties for rent in the United States. So I'm not going to spend much time talking about the basics of the rental apartment market, but I do want to spend some time talking about the opportunity that exists in the U.S. today for investment and why it should be compelling. It's compelling to us, and why it should be compelling to you. So I'm going to skip through a few slides here and get to what really makes the most sense here. When we talk about real estate, there are two components of the valuation model. There's the capital markets, the flow of capital, investment capital from you and equity, debt capital from lenders, and then there's the space market. We're in the space market right now. There's a room, supply, and we're demand. We're here. And in the space market, we have to look at both the supply of space and demand for space. In the United States, in the apartment market, there is a tremendous increase in demand that's underway relative to the past number of years. What this slide shows here is the number of people, and it starts here in 1979 and goes forward for a number of years. And these are the number of people in the United States who are in their primary renting years when they live in apartments. And in the United States, that's usually between the ages of 22 years old and 34 years old. 65% of that population typically rents apartments. They move away from their parents' home, they get their own apartment, they rent, and then eventually we age and we start to buy homes when we have families and so forth. But in that 22 to 34-year-old age group, most of what we do is we rent apartments. And so what this chart shows you is the number of people in the various years who have been in their primary renting years. For example, this big bulge here from 1979 through the late 1980s, that was my generation, the baby boomers. I'm on the back end of that generation, and there are 78 million of me and my peers. And we came through our primary renting years in the late 70s through the late 80s. We rented apartments. Now we're still here, we're just not 22 to 34 years old anymore. We're older, we moved into our home buying years, and we drove home ownership for the next number of years. But coming behind us, the next generation of people coming into their primary renting years, you see a huge drop-off here. This is a much smaller generation, referred to as Generation X. There are 78 million of my generation. There are only 42 million, there are only 42 million of Generation X. So for the last 15 to 20 years, there have been 42 million units of people moving through the demand curve for apartments. They're gone through that situation already, and they're into their home buying years. And quite frankly, the reason you may hear about home buying being down so much in the United States, part of that reason is because there's just a lower number of people in their home buying years than there used to be when my generation came through. But what we're really here to talk about tonight is the opportunity on the demand side for apartments, rental housing. The next generation, Generation Y, as it's referred to, or sometimes the echo boomers, the children of the boomers, is coming through their primary renting years. We're here in 2012, and this generation is 81 million strong. We don't have to guess. They've already been born. We know how many people are going to be 24 years old next year. And so for the last 15 years, we've had 42 million units of demand coming through the primary renting years. And now we're shifting into 81 million units of demand coming through the primary renting years. So you can imagine there's a tremendous increase in the demand for apartments given this generational shift. So then, as we think about the space market, we think about demand, but we also have to think about supply. And there is new supply that can come to the marketplace. This chart here shows new supply of apartments, new starts for construction, going back to 1979 through 2011. What's important to note here is that supply has come down. And the reason supply has come down is not because there's no demand. You just saw on the previous chart, there's significant demand. What happened that caused supply to come down was the financial dislocation in 2008 and 2009. They carried over into 2010. With the financial dislocation that started in the United States and spread throughout other economies, there was no construction financing that was allocated to any new supply. Banks, life insurance companies, pension funds would not lend money for any new development. So there was no new development started in 2008, 2009, 2010, and very little started in 2011. And so it takes, if you think about supply, it takes time to buy the land, zone the land, entitlements, get your building permits, get the land financed, and then actually build the product. That's about a 3 to 5 year process in the United States, depending on which market you're in. So if there was no financing in 2009 and 2010 and very little in 2011, That means there's no delivery of supply in 2012, 2013, 2014. And so if you think back to the previous chart here, where we have a tremendous increase in demand driven by this demographic wave that's coming through, and we look at new supply that has been essentially cut off, not because there's a lack of demand, but because there was a lack of financing. And there was a lack of financing caused by global economic issues. So we have this tremendous convergence of events. Putting these two charts together, we have demand that's increasing rapidly, and it's undeniable. We're not guessing. We know that the demand is there, and we know that supply has essentially been cut off, or very small amounts of new supply. So you can imagine what happens in that type of environment. Demand goes up, and there's no supply. You can imagine what happens to pricing. The first thing that will start to show before rents increase dramatically is occupancy. Vacancy rates in the United States back in 2003 were 9%. The vacancy rate was high then because a lot of people were buying homes because financing was very easy. You didn't have to put any money down to buy a home. You could get very attractive financing. And so a lot of people were buying homes that perhaps should not have been, but they did. And so vacancy rate in apartments went high, 9%. It's come down, it came down to 5.9%, but then during the economic dislocation, with unemployment, people lost their jobs. Some people moved back home. They were in apartments, they moved back home, or they doubled up. I had an apartment by myself, my friend had an apartment by myself. We couldn't afford it, so we moved in together and shared an apartment. That caused vacancy rates to increase. The important thing to focus on going forward is that with this increase in demand and the lack of supply, vacancy rates are projected in the United States for apartments to be 1.9% by the end of 2014. That means we're going to be 98.1% occupied. That's unprecedented in our country. The highest occupancy the U.S. has ever had in apartments was 95.6%. And it was back in the late 80s, back here, when my generation was coming through their primary renting years. This is an unprecedented level of vacancy, low or high demand, and it's caused by this convergence of demand and no supply. And so you can imagine what's likely to happen with rental rates. Occupancies are going to be more than full, and so rents will accelerate well ahead of inflation, which is the opportunity. And this is what's going to drive value creation going forward for investments in apartments for the next 3 to 4 years. We have a lot of clarity. A lot of times when we look forward with our projections, we're not so sure what's going to happen 2 and 3 years from now. But in this situation, we do know how many people are going to be in their primary renting years, so there's a lot of clarity there. We do know how low supply is. There's a lot of clarity there. So the projections for this very low vacancy rate has a lot of clarity to it. There's not much dispute that this is likely to occur. As we get out further, we have less visibility because we don't know what starts on new construction may happen in 2015 that may deliver in 17 or 18. But for the next 3 to 4 years, we're highly confident that demand is going to significantly outpace supply, which creates an investment opportunity. We've already seen in the capital markets an acknowledgement of where demand is going for apartments. When you think about capital when it leaves a sector, when it leaves technology, when it leaves healthcare, manufacturing, real estate, and apartments. When it leaves, prices drop because there's less capital demanding the investments. But when the capital comes back, it first comes back to the blue chip companies, the highest quality companies, in the case of real estate, the highest quality assets. And it bids those prices up. This chart here shows cap rates or yields for acquisitions of apartments between the highest quality assets, the next the next sector, Class B assets, and then the third tier, Class C assets. And what you've seen here is that yields for new properties, Class A, or the highest quality properties, have dropped. Not because the operations have gone down. The income from the properties have actually gone up. It's just that the buyers are willing to pay more for the asset, which is bringing down the yield on the initial acquisition. If you look at this chart and look at the normal spread between A property pricing and B pricing and C pricing, you see some relative spreads that maintain during normal time periods. What's happened over the last two years is that there's been a tremendous amount of capital that came back to the sector, and it went to the Class A properties first, the blue chip assets, bid their prices up. It created a gap out, or spreading, a widening of the spread between the A assets and the next tier, the Bs, and then the next tier, the Cs. As capital continues to price these assets at very high levels, it will start to look downstream for valuation and yield. You know, if you buy a high-tech manufacturing company that's a blue chip company, at some point the price gets too high for you, and you're willing to sell and redeploy your capital into the next tier, because the valuation and yield spread justifies trading that capital out and going into the next tier of investment. The same type of thing is going to occur here in the United States for apartments. There's an awful lot of capital looking for the Class A assets, less capital looking for the Bs, but it will start to shift downstream over the next several years. So there's an opportunity to play at this level and generate some outsized returns by capitalizing on the arbitrage between the A pricing and the B pricing. So thinking about what I've spoken to over the last few minutes, there are several conclusions. First, demand. Demographics are driving a significant amount of demand. What I did not talk about was the lack of the home ownership rates in the U.S. coming down. Fewer people are buying homes. That means those people are staying in apartments longer. So they're increasing demand as well. So that chart I showed you on demand was really only speaking about the demographics, not about the amount of people who are choosing to stay in apartments longer because they have to pay more money to make their down payment. So we've got demand that's booming. We have supply, pardon me, we have supply that is curtailed. Not because the market doesn't need supply, it's because the financing wasn't available. We also have occupancies that are going higher than they've ever been in the country, which will result in rents going higher than they've ever been before. And we've got capital flows. A significant amount of capital is coming back into the space because it recognizes the demand and the supply and the impacts it will have. As more capital comes in, it will bid all prices up. So there's a component of this investment opportunity that is fundamentally driven from demand and supply. And there's also a component of the return profile that is capital flow driven. When capital comes into a space, it will push all of the prices up. Just as when it leaves a space, all of the prices will decline. Now let's talk about Cortland Partners for a few minutes and what we're doing to capitalize on these opportunities. We started our firm in 1996, primarily as a development company where we built new assets. And we like to play the cycle. There are times in the real estate cycle to develop assets. There are times to acquire. There are times to sell. And the sell discipline is extremely important. Where we are right now in the real estate cycle, given the recovery that's occurring in both the space market, demand and supply, and the capital market with capital flows, we think the best risk-adjusted returns for us are by acquiring assets. And so we are acquiring assets rather than developing. Now we do a little bit of development, but 90% of what we're doing tactically today is acquiring assets to capitalize on the fundamentals I've just described to you. We have a portfolio today of 8,666 apartments we own. We have another almost 2,000 apartments under contract to acquire, so our portfolio is growing. We have acquired 26 properties in the last 22 months, capitalizing on this recovery. We jumped ahead of the curve and started buying early, recognizing what was likely to occur in the space market and the capital markets. The markets that we operate in are, while we're based in Atlanta as our headquarters, we're in a number of markets throughout the southeastern part of the United States. Texas back through the Washington, D.C. area. We chose these markets specifically, not just because they were the next major market to go to, but because we looked at the underlying jobs that support these economies. There's a different level, there's a different stratification or allocation of jobs in Atlanta than there is in Houston. Houston, you might imagine, has an awful lot of energy-related, oil-related jobs. 45% of its economy is tied to the energy industry. Atlanta has very few energy-related jobs. So you have different types of drivers. Austin, Texas, in the middle of the state here, has a very different job base than you would find in Orlando, Florida. And so we look at the underlying jobs that support the economies and how those jobs are going to be correlated to the national economy. We want to understand how they're correlated to the national economy because the national economic situation will impact these individual markets. We also want to know how these markets are correlated to one another. If all of your markets go up at the same time, you really enjoy that. But when they all go down at the same time, that doesn't feel so good. So we want to have markets that are out of phase with one another. So we have some markets going up while others are going down. We can choose to allocate capital to the markets that are on the rise as opposed to the markets that are on the way down. That gives us an opportunity to make smart decisions on allocating capital and how we operate our portfolio. I wanted to run through 2 examples of assets we've acquired in the last couple of years, and then one current opportunity for you. The first case study here is a property in Atlanta, Georgia. We call it Dunwoody Glen. But we purchased this property in June of 2010, so less than 2 years ago. And our total capitalization, we acquired the property for a little over $10 million. We put about $5 million into the asset, renovation of the asset, a number of things, windows, new roofs, carpet, a variety of things that we renovated the property. And we created a substantial amount of value. The property was appraised in December of 2011, just 18 months after we purchased it. We have a total of $16 million invested in the asset. It was appraised at $24.7 million. Significant amount of value we created, some of which we created, some of which the market created. But we'll take all of it. Interestingly enough, the rents when we purchased the property were $591 per apartment per month. They're now $689. The occupancy, economic occupancy, was 60%. It's now at 87%. So these are the types of improvements we've been able to achieve on these types of investments. The net operating income coming from the property, revenues minus expenses, has gone from $350,000 annually to almost $1.5 million. So a significant amount of value creation through our execution. The next asset that we have here that we have already executed on is actually not very far from the previous one, Hunters Ridge in Atlanta. Similar situation. We bought the property for $7.7 million, put $1.5 million in it. We have a total basis of $9.8 million. The property is valued today at about $13.6 million. A significant amount of value creation through this process. Again, over a very short time period. We bought it in February of 2011, and so we're now just 14 months into our ownership period, but have created this amount of value through our execution. Rents, $523, now they're at $578. Occupancy and the NOI, as you see here. So We've acquired 26 assets in the last 2 months. These are just 2. We have 24 other ones that are coming through the system in a similar fashion. A current opportunity that we have under control, under contract, that will close in several weeks is a property, again, in Atlanta. It's referred to as Toscana, the name. We are buying the property for $7 million. The existing loan on the property is in excess of $14 million. So we're buying the asset at a significant discount to what the previous owner had in the asset. As a matter of fact, most of these acquisitions I'm talking to you about, we're buying from someone who never intended to own the property. They were the lender. They loaned a lot of money in 2006 and 2007. The collapse came in 2008 and 2009. The properties didn't hold up their values, and so now the lender took them back. The lender doesn't want to own them, and so they're selling them, gives us an opportunity to buy at a very attractive price. So we'll buy this property, Toscana, for $7 million. We'll put about $3 million in the asset. We'll be all in at about $11 million. Based on existing cap rates in the marketplace for a renovated and stabilized property, we should have about a $13 million value there, so creating a couple $1 million in about a 6 to 9 month window. This asset currently has rents of $532 per month per apartment. The stabilized is at $600. These are rents that are already in the marketplace today, and we'll just we'll renovate the asset, stabilize the occupancy, and move the rents just to market, not above market, just to the market. So these are the type of opportunities that exist for us. This arbitrage window where we have lenders who are selling assets probably has another 12 to 18 months of time to run. You know, arbitrage opportunities, you see them in all types of investments. Arbitrage opportunities get closed by the market forces. And the market forces will close this window, but we probably have another 12 to 18 months where we can still buy these properties very attractively in the markets that I showed you, add some renovation dollars, significantly improve the operations and the value potential for our investors. Those are the prepared remarks I had. I don't know if there are any good questions. I apologize if I spoke too quickly, or if you didn't understand. We'll be available over the next several days or through Uzi to take questions. But if there are questions now, I'd be more than happy to fill them.
I want to ask about the supply and demand.
Yes.
You talk about the supply and demand as is. What about the supply that is in the bank's inventory?
In the bank's inventory of apartments?
Of equity, of real estate equity,
yes,
in general.
Sure. That's a very good question. And the occupancy nationwide for apartments today, including the occupancy at the properties the banks own, is about 94.6% today. So nationally, we're already full from an occupancy perspective. Now, there are some properties in some markets that are 96 or 97% occupied, and in other properties where 89%, and in other markets where they may be 89% occupied. That creates an opportunity. If you can move the 89 just to the average of 94, it creates an investment opportunity. But the properties that the banks own today are included in that statistic. So we're 94.6% occupied nationally already, which is very high occupancy. And but you bring up a very interesting point. The banks don't know how to manage the assets. They're not interested in operating the assets. And so typically we find the opportunities to increase occupancy are associated with assets that the banks have. And that's why we're buying them from the banks. Properties that we already own, we've already moved our occupancy up. Those that we buy from the banks are the ones where we have that opportunity to move the occupancy up. Yes, sir.
You're talking about multi-family apartments.
Yes.
What do you think about single-family homes?
Single-family homes, there is, we obviously built an awful lot of single-family homes in the 2000s, the first decade, the first 7 years of the 2000s, more than we needed from a demand perspective. There is an overhang of single-family homes. Those single-family homes, though, are usually further out because the developers of those single-family homes, they bought large tracts of land, went in and did their single-family home development. So a lot of the homes that are vacant are in further out locations. And the resident profile that is looking for apartments because of energy cost, but our prices in the States are a lot lower than yours here, but it's still expensive for us. And so people want to live closer into the employment centers. And so they're choosing not to live further out where those single-family homes are. What you also have probably read or heard is that a lot of single-family homes have been foreclosed on, and they have. And the people who were in those homes became renters in other single-family homes. They were already living in that further out location, and so they got foreclosed out of this home, and then they just chose to rent the home that was foreclosed down the street, if you will. So we are working through that inventory. It has come down quite substantially. There is an investment opportunity in single-family homes, but it's a very different operating business than the multifamily homes where we have 300 apartments in one property or one community. We don't, that's why I do believe, and you'll find us and other companies like ours, not buying apartments that are very, very far out where we have exposure to single-family rentals. We're a little bit closer in. We're not in the urban core because the urban core is where those Class A blue chip assets are, and they're already full. But we're in that next ring, but we're not further out where most of the single-family homes are. Yes?
We did not see on your chart anything about Arizona or Phoenix. This is because it's too far west, or because out of focus, or because it's not good enough?
Well, I wouldn't tell you that it's not good enough. The stats, most of the stats I talked about are national in scope. Where we have decided to invest, based on our research, is we were able to achieve exposure to the job base that is in Arizona and parts of Southern California. We were able to achieve exposure to those jobs through the markets that we selected. We don't have to go there to get exposure to those jobs. Now, if we wanted to go there for geographic reasons, have hurricanes in Florida, you don't have hurricanes in Phoenix. But that's really not a reason for us to make it. We really are looking at economic diversification, and we have exposure to the types of jobs that are in Phoenix and in many of the Southern California markets already through the markets we're in. So that's why. I would say that if you've got the right operator, investor, operating partner in Phoenix, you should do fine. There's other markets, Washington, the state of Washington, Chicago, Denver, Boston. You can make money in those markets. Just not where we've chosen to invest. Yes, sir.
You mentioned the demand is influenced strongly by the renting edge volume.
Yes.
You didn't mention the unemployment, which is also another influencer, strong influence.
You're exactly right. I'm glad you brought that up. Unemployment or job creation is the primary driver of demand for all of the space market: office, retail, apartments, hotels, to some extent. So job growth is extremely important. You'll find that the markets we've identified are are some of the top job growth markets projected for the next 5 years in our country. And the young population, 22 to 34 years old, they're very mobile, so they will move to where the jobs are. Unemployment in most of the markets has come down. You'll find unemployment in the markets that are heavily manufacturing oriented. I'll pick on Detroit, which was automobile. Unemployment there is extremely high, much higher than it is in Atlanta, in Dallas, in Houston, in Jacksonville. So, but it is important to look at, and that's why we study those underlying jobs that support a market and how they're correlated to the national economy, because we want to be in markets that are resilient, that when the national economy starts to improve, those markets are resilient and they recover faster, and that's going to bring that unemployment rate down. We're already at 94.6% occupied nationally for apartments, with unemployment in the high 8s. So any improvement in unemployment will benefit the job growth and therefore the population growth and household formation in the markets for apartments. It's interesting. During this time period here, it took 4 jobs nationally to create 1 unit of apartment demand. 4 jobs nationally. During the 90s, it took 12 jobs to create 1 unit of apartment demand. Why? It's because the people who were taking the jobs were in their primary renting years. The people who were taking the jobs here were in their primary home buying years. And so there's differences in the number of jobs nationally to generate 1 unit of apartment demand. Well, if you look at the slope of the curve, we're now on a similar slope to where we were in the late 70s through the 80s. Is it going to be 4 jobs create 1 unit of apartment demand? I don't know, but it's probably not going to be 12 jobs. So we're probably in a very favorable environment for job creation relative to demand for apartments, just because of the age group of the people who are taking the jobs. The younger age group has more skills, better educated than the older age group who was in a manufacturing job for most of their career, and those jobs don't exist today. Yes, sir.
I'm not sure you can hear me. Can you hear me?
Yes.
How many of the units you acquired, you mentioned before, are preoccupied by inhabitants who are problematic, who doesn't pay the rent, or you cannot raise the rent for years
Sure.
because they already live there?
Yeah, very good question. One of the reasons apartments are viewed so favorably as an investment class is because the lease term is 1 year. And so within a year, the leases roll over or they renew, which means in a rising rate environment, you're able to capture the increases in rents quickly, as opposed to an office building which may have 5- and 10-year leases. Also in a downturn, as the rents are going down, your rents go down much faster. We've already been through the downturn, we're now on the upside. But your question about how many people who are living there can pay is very important, because we find that as the banks take over these properties, a lot of times they're filling them up, but they're not collecting everything they're supposed to collect. And it's most of the properties we have acquired have had economic occupancy, collection, in the low 80s. Even though the property may be 90% physically occupied, the collections are down in the low 80s. That's one of the first things we do to turn around. We do extensive audits of the lease files. And in our part of the country where we've chosen to invest, within 45 days of non-payment, we can evict someone. Very, very easy for the landlord to move someone out if they don't pay. You go to Manhattan or Boston or some of the northern parts of the U.S., it could be 6 months or a year before you can move people out because the laws are different. But in our marketplace, we're able to move people out pretty quickly if they don't pay. And we underwrite our investments expecting to move a meaningful percentage of the people out. And we do that. It's usually around 10%, and we increase our collections. The Hunters Ridge property that I showed, when we bought that property, collection loss was 10%. It's now 1.5%. And that was a combination of 2 things. One, we asked the people who didn't pay to pay, and so some of them did. And then those who didn't, we moved them out and we replaced them with people who do pay.
I'm gonna give you the last question, if I may.
Okay.
And my last question is, if you can address what type of returns are you generating from, or expected to generate? What did you generate on the deals that you already sold or refinanced?
A very, very good question, and I apologize. I should have addressed that because that's important. That's why we're here in returns. The returns that we're looking at today on our investments, the IRRs during our hold period, are projected to be in the high teens to the low 20s. Some of the investments we made 2 years ago, very early in the cycle, we caught very well. That Dunwoody Glen property, that return, that IRR is going to be 80%. I'm not going to promise you we're going to do 80, but we are underwriting to the high teens to the low 20s. In some cases, a little bit higher, depending on where we are in the curve. But those are the types of internal rate of returns that we're generating during our whole period, which We underwrite for a 5-year hold period. And many times we may sell a little bit earlier than that. But depending on the asset, if we're buying a Class A asset, and we do buy Class A assets, and we develop Class A assets, we'll underwrite a longer return hold period. But for these distressed acquisitions, we're typically underwriting a 5-year hold period, in some cases only a 3-year hold period, as we capitalize on the arbitrage. What's really important to us, a number of things are really important, but one of the things that is really important is the sell discipline. We need to be able to take profits off the table when it's the right time. And almost everyone who has been hurt in real estate in the United States has been hurt because they didn't sell when they had the opportunity to, and then they wrote it down. And we want to avoid that. And we actually have a history of exercising this sell discipline and monetizing, realizing the profits that we've created through our execution.
Do you refinance?
Yes, we do. We do. As a matter of fact, who's the woman? Refinance is very important because we are buying assets that, on these distressed plays, we're buying assets and using bank financing to do the renovation and stabilize the asset. As soon as we get the asset stabilized, we go back to Fannie Mae or Freddie Mac, the two government agencies, and put long-term financing in place, believing that when we go to sell this asset several years from now, if interest rates have gone higher, these rates are assumable, and someone who's going to be buying the income stream from the real estate may also find value in the debt we have on the asset, and we think that's another arbitrage play. So we do look for long-term financing once we've stabilized the operation. Thank you.
Thank you.